Well, we're a half an hour away from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Stephen Engle with David Ingles.
Good morning. Let's get to your top stories today. China's securities regulator is set to hold a briefing, in fact, any moment now, with the Finance Ministry and also the PBOC. That's after rolling out a basket of measures to boost the stock market.
And NVIDIA's Korean partner SK Hynix posts record quarterly profits, extending its lead in advanced chips for data centers and AI development.
Also ahead, Elon Musk getting into a public spat with OpenAI Sam Altman over whether backers of President Trump's AI plan really have the money.
And we will speak exclusively to the American Chamber of Commerce about how businesses in China are navigating the economic slowdown and geopolitical tensions.
Good morning again from the Asia Pacific. Welcome to the China Show. The market story is one that is fairly simple at the moment. Nothing's happening. There we go. Equity markets are flat. You do have, of course, idiosyncratic stories like the chip story in South Korea with SK Hynix and earnings. Apart from that, though, the macro seems to be more behaved today. The dollar has come back the last, I would say, 24 hours or so, following the weakness, of course, earlier in the week. We are, of course, waiting for this briefing in Beijing to start. And the reason that's important is that it's usually held later in the morning or in the afternoon. That's point number one. Point number two is you do have the CSRC chairman, Wu Qing, attending with the deputy finance minister, Liao Min, and also central bank PBOC official, Zhou Lan. So they are set to lead this briefing. We broadly have an understanding what they'll talk about. Certainly, markets will be attuned to details of how they plan to, of course, increase the access for longer-term funds back into this market. So far, the commentary is positive, although, again, we're waiting for details. Speaking of details, we'll toss it directly now to the briefing, which I believe is getting started in Beijing.
Our calendar. Yesterday and today are the minor New Year's in the traditional Chinese calendar. Even though we're in holiday mood, we cannot let a major event pass without noticing. That's why we are holding this press conference today to brief you on the implementation plan issued by 6 departments upon approval by the Central Financial Commission promoting the entry into the capital market of medium to long-term funds. A press release was issued yesterday afternoon. And today, in this press conference, together with my colleagues, we would like to brief you on this implementation plan as we are leading officials from departments responsible for the drafting of the document. We would like to brief you on the background, the main content, and the relevant arrangements concerning this plan, and to take your questions. As you know, medium to long-term funds are an important specialized force of investment in the capital market. They are the anchors and stabilizers for a sound and smooth-running capital market. The CPC Central Committee, with Comrade Xi Jinping at its core, attaches great importance to the entry of these funds. At the third plenum of the 20th CPC Central Committee, it was made clear that the functions of the capital market should be improved to give equal balance to investment and finance, and to support the entry of long-term funds. Following the Political Bureau meeting in September 26 last year and the subsequent China Central Economic Work Conference, it was decided to stabilize the stock market, to deepen the comprehensive reform concerning investment and financing, and to
中央金融办和证监会联合印发了关于推动中长期资金入市的指导意见。这个指导意见里面也明确地推动各类中长期资金入市，构建长前长投制度环境的重点工作的安排。指导意见发布实施以及支持资本市场、货币政策工具等这一篮子的增量政策落地见效，对市场的稳定也起到了有力的支撑作用，推动了市场的回稳向好。这次印发的这个实施方案，既是深入贯彻落实党中央关于推动中长期资金入市决策部署的又一个重要的具体的举措，也是对前期指导意见的一个细化、深化和具体落实的工作。这个实施方案聚焦公募基金、商业保险资金、养老金等等一些中长期资金入市的卡点、堵点问题，提出了一系列更加具体的举措，既立足于当下，确定了各类中长期资金入市提高投资 A 股的实际规模、比例一些具体的明确的指标的要求，更着眼于长远，从建立适配长期投资的考核制度、投资政策、市场生态建设等等方面，做出了一些针对性的制度安排。这个可以说也算是干货满满啊，有这么几个要点。一个是提升实际投资比例，经过认真的研究论证，明确了稳步提高中长期资金投资 A 股规模和比例的具体的安排。对于公募基金，明确公募基金持有 A 股流通市值未来3年每年至少增长10%。对于商业保险资金，力争大型国有保险公司从2025年开始，每年新增保费的30%用于投资 A 股，这也就意味着将每年有至少是为 A 股的新增几千亿元的长期资金。
Hundreds of billions of yuan will go into A shares from these state-owned companies.
还有就是第二批的保险资金的长期股票投资试点。也将在25年上半年落实到位，规模不低于1000亿元。一会儿袁启局长也会跟大家来介绍，后续还将逐步的扩大。二是延长了考核的周期，考核周期是多年来制约商业保险资金、年金基金等一些中长期资金扩大 A 股投资的一个重要的卡点。那么实施长周期的考核，能够有效地熨平短期市场波动对业绩的影响。因为本来是个长线，但是考核周期过短的话，它就不能长投。通过考核周期的调整、拉长，它会提升中长期资金投资行为的稳定性，有廖百跟大家来介绍啊。所以这个实施方案进一步的提出，公募基金、国有商业保险公司、基本养老保险基金、年金基金等等，都要全面的建立实施3年以上的长周期的考核。大幅度的降低国有保险公司当年度经营指标的考核的权重。细化明确全国社保基金5年以上长周期考核的安排。对中长期资金入市的工作来说，这是一个非常重要的制度性的突破，可以说是解决了多年要解决没解决的问题。从境内外的实践经验来看，这也有利于改善各类中长期资金投资回报，也实现共赢。 举一个例子，
boost
像
the
全国社保基金，
return on
这是境
the
内参与
investment of
股票投
short-term,
资啊，
of
也
medium-term
是
to
最积
long-term
极的
funds and achieve
真
a
正的长
mutually
期资金。
beneficial
它成立
outcome.
20多年，投资
National
A 股
Social
的
Security
平均的
Fund
年化收益率实际上达到了
It's the
11.6%，
longest-term fund that
这是很高的。
participates actively in the
这
investment
主要是得益
in
于
stocks.
社保基金
Since
坚
its
持长期
establishment over 20 years ago,
价
the
值投
revenue,
资、长期投资。
annual revenue has exceeded
这
or
其中
has
的经
reached
验应该说也是很值得
11.6%.
认真的总结
This has
借
to
鉴。
do with its consistent
三是
practice of
进一步巩固
investing
形成
for
了落
value
实
in the
增
long
量
term
政策
and
的
its
合力，
good
大
experience
力引
that
导
we
中
should
长
draw
期资
on.
金入市啊，
Thirdly,
是一项系统工
We
程
should。continue to build synergy for
实
delivering
施方案
on
的
the
制定
incremental
过程中，
policies.
中央金融办
The
加
entry
强统
into
筹
the
协调，
market is a long-term
财政部
systematic project.
人
And
力
as we
资
work
源
to
社会保
implement the
障部
implementation
人民
plan,
银行
the
金融
Central
监管
Financial
总
Commission
局
will step up
社保基金理
coordination,
事会
and
等
us,
等
the
这样一些
relevant
部门和我
departments
们一
will
起
collaborate
紧密的
closely
协
and
同
carry
配合
out our
有一
work
些也是创造性的
in
开
an
展一些工
innovative
作，
way
共同推进，
in
形
order
成
to
了
jointly
刚才介绍这些
contribute
具体的
to the
有力的
implementation
政策
of
举措。
those
应该说
strong
这也是
and forceful
重要
policy
的
measures that
立
I just
长远的
mentioned.
一些
So
制度
what we're
性改
doing
革。
is
在
important
后续的落
and
实过程当中，我
focus
们还
on
将继续的
long-term results.
加强沟通协作
And，
强化跟踪问效。
We will continue
我
to
们相信，
strengthen communication,
在党中央国务院的
collaboration,
坚强
and
领导下，在各方面
work
的
in
大
a
力支持下，
results-oriented manner. We
实
believe
施
that
方
under
案
the strong leadership of the
各
CPC
项
Central
举措落
Committee and
地
the State Council,
将进一
and
步
with
的
the
提
support
升
of all relevant
中
sides,
长期资金的权
the
益配置
implementation
的
plan, once
能力，
delivered, will continue to
稳步地
contribute to
扩
the
大投
equity
资规模，
distribution
改
ability
善
of
资本市
medium to
场资
long-term
金
funds,
供给与结构，
boost investment
巩
scale,
固
improve
资本市场
supply and
回升
demand
向好的
structure
良
in
好
the
的局
capital
面，
market, and contribute to
也
a
将有
sound
助于中长
recovery
期资
of the
金
market.
提
It
升
will also be
长期
conducive
投资
to
的回
boosting
报，
investment
更
returns,
好的践行长期投资、价值投资、理性投资
promoting
的
the
理念，
vision of long-term investment for the
实现
long-term,
中长期资
investment
金
for
的
value
保
and
值
rational
增值，
investment, and
资本市
contribute
场的
to
平稳
increase
健康
of
运行，
revenue and the sound
实体经济的
and
高
smooth
质量发
running
展，
of the capital market
这样
and
的
a
良性
virtuous
循环。
cycle for high-quality economic
我就
development.
先跟大家介绍到这
Let
儿
me
了，
stop
谢谢。
here. Thank you.
谢谢吴主席介绍，下面我们就开始提问。提问前还是请通报一下所
We
在的
now
新闻
open
机
the
构。
floor to questions, and please identify your media
先
affiliation.
这边吧，第二排这位记者。
谢谢。第一财经记者提问。那么我们看到实施方案就提出对国有商业保险公司这次是全面实施3年以上的一个长周期考核，请问是出于什么考虑？那么未来如何落实这个要求？谢谢。
years for state-owned commercial insurance companies.
财政部。
So what measures will you take?
好，谢谢
The
记
Ministry
者
of
朋友的
Finance.
提问啊，大家早上好。
Well, thank you for your
这
question.
个
Good
刚
morning.
才吴清主席呢
Just now,
也做了这方面的介绍
Chairman Wu Qing
我再呢
briefed you
简要
on
做一
this
个这个补充说明
information. So I will
对于国有商业保险公司啊，经营业绩实
to
施长周
implement
期
a
考
long-term
核，
performance assessment
是推动
for
了保
state-owned
险公司啊
commercial
利用
insurance
资本
companies.
市场进行这个
Is
中
an
长期投
important
资
measure to
的一个重
encourage
要的举措。
insurance companies to use the
首
capital
先呢，从这
market
个
to
保
have
险
mid
资
and
金的
long-term
属性来看呢，
investments.
具
First,
有
from
这
the
个来源稳
perspective
定、
of capital,
规模较大、
insurances
偿
have
付
stable
周期
source,
长的这
large
样的一个特
scale,
点
and long
是
payment
典型的这
cycles.
个
It
投
is
资
a
长线，
typical long-term
也是呢这个
capital
资本市场的这个重要的
and
参
an
与者。
important actor in the capital
保
market.
险资金投资这个资本市场呢，也是
Insurance
国际上
funds
通行做法
investment
和基本的
to
模
the
式。
capital market is also
从我国
an
国有大
international
型商业保
customary
险公司
practice
资
and
金
basic
运行
model.
的情况来
From the
看，
use of capital by
这个加
state-owned
大这个资本市场投
commercial
资力度
insurance
啊，仍有
companies,
一定的空
there's
间。
still room to increase investment
其次
in the
呢，这
capital
个资本
market.
市场实现高质量发展，
And second,
也需要啊，
high
包括
quality
更多
development of
保
the
险
capital
公司在内
market
的中
requires
长期
more
投资的资
mid
金
and
的
long
参
term
与。
capital.
All right, we've been listening to the CSRC Chairman Wu Qing, as well as Deputy Finance Minister Liao Min and the Central Bank official Zhou Lan holding that briefing, Dave, in Beijing, the State Council Information Office. A few of the headlines, Wu Qing, again, they're going off this press release that they issued earlier, saying that the central government had issued a directive to steady the stock market and clear bottlenecks for the introduction of mid to long-term capital. Wu Qing there was speaking about mutual funds raising their A-share investment. There could be injections of hundreds hundreds of billions of yuan into A shares. But again, he emphasized several times that this is long-term development, not necessarily just for a short-term boost to the stock market, which, of course, the A share index, the CSI 300, down some 3.5%. so far this year, one of the worst starts in about a decade for the A-share market. It's down 35% since that high, of course, in February 10th of 2021. And remember that peak in October? Seems like a long time ago.
Yeah.
Down 11% since October 8th. So they are obviously doing something, a number of different things to stabilize the stock market with the uncertainty with the Trump tariffs and the incoming U.S. administration.
Yeah, this vacuum between when the economy responds or, of course, when relations, and hopefully relations improve. To Steve's point here, this is a longer-term exercise. In fact, just to highlight that, one of the numbers that did come out of that is that mutual funds, according to the CSRC, will be raising their A-share investments by 10% each over the next, in 3 years' time. Let's get the initial take with Tai Hui, APAC Chief Market Strategist at JPMorgan Asset Management, here with us in our studios. You've been listening into as well to this briefing. Any takeaways so far for you?
Well, I think the immediate market reaction would be, as you rightly said, the short-term potential impact of sentiment rather than actual capital going into the markets, because ultimately this is very much a medium to long-term directives. I think the interesting point is also at the same time the desire for insurance companies, pension funds to continue to enhance their return.
Yeah.
That's largely due to the aging population, the social safety that needs to be broadened to help people. But at the same time, does that mean that implicitly government policy will be more geared towards facilitating a healthy stock market? There's a lot of discussion about governance, about how to improve corporate profitability. But at the same time, in the last few years, whether it's in 2021 with the tech crackdown, with a number of policies, I think companies went through quite a roller coaster ride when it comes to regulations on the macro environment. And in that sense, for these pension funds and insurance companies to do well or generate the right amount of return, we do need a change in policies that's more facilitative or more positive, more constructive for corporate. So I think there's a lot of thoughts on that, but I think in the immediate reaction would be, is it for boosting the market in the short term? Probably not, but it's more for the longer term.
I mean, do they have to sort of forced incentivize these state-owned enterprises and these mutual funds to invest in a market which has been down? You don't want to catch a falling knife. So how much incentive is there through this policy to get these large funds into the A-share market?
Well, I think that's a key point. If these investors, institutional investors, then they always have at least internal expectation of how much return they're going to generate.
Right.
If that expectation starts to build or go up, then they would increase allocation. As you rightly said, you can open a door. Whether they go through or not, that's a different question. At the moment, I think the challenge would be we have a very low government bond yield environment. A lot of investors still need income, both retail and institutional. And at the same time, the macro environment, both internal and external, continues to be quite uncertain. So I suspect that the long-held strategy of high dividend stocks in China, at least for the time being, that will continue. But depends on other macro policies, fiscal, monetary, how much of that is going to change the dynamics of the Chinese economic growth. You could potentially see a rotation back towards technology, back to consumer goods, if we start to see more momentum built into the economy.
I mean, going into this, to your point, some of these measures are really aimed at making the market longer-term sustainable, right? The last thing you need, obviously, is a market that just goes vertical over the next few months and then comes back down. And I mean, that's going to, in the end, hurt insurers anyway if that sort of thing happens. What are the structural bottlenecks you think that they are either addressing right now or they need to address that have prevented your patient, long-only money, domestic money, going into this market?
Well, you just saw exactly what happened in that 2 weeks at the end of September last year, right? It's up 30% and then gradually comes back down. I think the benefits of having insurance companies, pension funds, long-term investors going in is that you do have as the chairman rightly said, you do have a bit more of an anchor of stability. You have less retail. Well, you dilute the retail participation, which can be very fickle. It can be in and out, swinging wildly. With longer-term investors, you do have a bit more of a foundation of the investor base. That should help to correct some of the unnecessary volatilities in the market. So I think that's a start. But at the same time, it comes back to the macro fundamental. It comes back to how investors, professional investors, see the investment environment in China. I think at this point, many are still relatively conservative, a bit more cautious. We do need some of the macro cyclical factors like how the housing market the job market to come back into a much favorable picture.
And those are a lot of the factors that you talk about that have affected international investors, institutional investors into the A-share market. We've seen outflows. What, on first blush, what does this mean for the foreign institutional investors?
I think that is, to me, this is like stacking the firewood to build a campfire. We are setting up for potentially a more constructive environment, but you need a spark to get that going. I think one of them, obviously, is domestic, as we just discussed. The other one is coming back to China's international relationships, especially with the U.S., because a lot of investors internationally, they are concerned that further deterioration in U.S.-China relationship could impact on investment, especially in the domestic Asia market. So, for example, if we do get a more constructive, a more amicable relationship between Washington and Beijing, that, to me, could potentially pull some of this money back into China. But obviously, that depends on how President Trump is going to play his cards when it comes to tariffs, when it comes to other economic and geopolitical relationships with Beijing.
That's an interesting point you make, because we keep looking at the economy and also Chinese earnings to maybe be that catalyst. And I think you make a very good point that counterintuitively, could Donald Trump be the actual catalyst here for Chinese equity markets?
I think that's a very much less talked about potential positive catalyst. We often talk about the stimulus. We're all waiting for MPC in March. Sure, I think that makes sense. If you look at scheduling, that makes sense. But to me, I think domestic economic recovery is not sufficient to draw more international capital back in. When we speak with, for example, emerging market investors, they still want to invest in China. They need the fundamentals, the corporate earnings to improve. Right. But for a lot of U.S., European investors, I think the geopolitics, especially after what happened in Russia, Ukraine, many of them are a bit more conservative, a bit more risk averse. So from that angle, the external catalyst could actually be quite powerful.
Not to get into a history lesson, but can you draw parallels to what Japan did during Abenomics with GPIF to basically boost domestic allocation?
I think so, but then the case of Japan is not only domestic investors going in, that's a key part. But of course, the BOJ buying ETFs, that's another way of pushing more liquidity, more capital into the markets. And at the same time, the underlying change in corporate governance in Japan, I always describe it as watching bamboo grow. Yeah, if you keep looking at it, it doesn't change very much. Yeah. You walk away, come back in a few years' time, there's significant improvement. So I do think that a lot of the governance reform that China and Korea talked about potentially can be very beneficial. But again, this may not be sufficient as a short-term catalyst to improve momentum in the next few weeks or months.
I like that analogy. I mean, the other one that I like is, it's almost like watching paint dry.
Yeah.
Right? It's slow, but I mean, it's efficient and it's going to get there. A lot of what you mentioned there is, I think in recent last 2 years, they've actually encouraged state-owned enterprises to either return money or be more efficient in terms of shareholder returns. They've also been talking to the private enterprises in terms of these buybacks as well. What I'm curious to know right now is, the headlines seem to suggest that there is a lot of domestic institutional money that is not yet in the A-share market. Mm-hmm. Where is that money now? I'm curious.
A lot of them are still in the bond market.
Okay.
Partly because everyone expects bond yield to continue to fall, despite PBOC cautioning investors. And we do see some money moving into international markets, for example, via the QD quota or the mutual recognition of funds between China and Hong Kong. But I think a lot of them is now, frankly, parked in cash. Yeah. So I think the question then becomes, how do you allow investors or how you encourage investors to deploy that cash back into the market? So I think a lot of this reform you've seen in the last 6 months, whether it's allowing medium to long-term investors to invest in, or enhancing their way to invest in stocks, or allowing companies to borrow to swap for equities, all of that, I think, is to really facilitate more capital into the equity market, and hopefully that will then draw more of that savings and retail money back into the market.
What do you make of the timing? Wu Qing alluded to the fact that they wanted to get ahead of the Lunar New Year holiday when people in the markets pretty much go away for a couple of weeks. But we'd all been focusing, as you rightfully said, the National People's Congress. I'm not saying that these financial officials are stealing the thunder of the stimulus for the NPC, but was time of the essence, do you think?
I think so. I think what you want to see is not necessarily everything bunched up together around the early March or just before and after. And also at the same time, I think the global markets in the next few weeks, maybe the next couple of months, because of the policies coming out of Washington, we could still see a bit more volatility. So in a way, again, I'm not stressing this is a short-term fix, but I think a lot of these policies will come through in trying to shore up investors' confidence.
And momentum and confidence is key, yeah.
Final thoughts, whether it's in China or elsewhere?
I think we still need to stay invested in China, but it just requires a lot more patience and also the rotation in different style, high dividends and growth. That rotation will generate significant alpha for investors.
Tai-Hui, thank you so much for being patient, like patient money, as they say. There we go. With us here on set, JPMorgan Asset Management APAC Chief Market Strategist, helping us unpack really the nuance here in this ongoing press briefing. TLI Vigo, by the way, for our Bloomberg clients, takes you also some commentary from our editors and our colleagues here covering this ongoing briefing taking place in Beijing. Certainly, we are feeling some tailwinds going into the open today, some strength coming through in the currency compared to at least before the briefing started. Futures are pointing to the upside. You are getting initial pricing on the mainland benchmarks on the way up. Hynix index is up over 1% in the initial goings. You are also getting quite a strong bid across some of these Chinese insurers, which have been talked about in this briefing as well, Steve.
A stronger fix.
Yeah.
Is that what we're seeing there? The yuan reference rate at 7.1708 per dollar. The estimate was at 7.2845. And this is something we will be talking later with AmCham as well, Dave, about the potential for the depreciation trend to continue for the renminbi, but we'll have to see.
That is the most opportune time, I think, to have a conversation with AmCham China, because the conversations really there will center around, I think, two things. One is how profitable are American companies in China and what they see as the outlook, and that goes into the geopolitical story and how much really does geopolitics affect what their expectations are as far as the bottom line is concerned.
Yeah, absolutely. And, I did talk to Al Gabor. He is the AmCham Shanghai chairman last week at UBS, Greater China Conference. And he said for the American businesses in China, the main focus is going to be on that yuan depreciation trend. And what does that mean for taking profits out before further depreciation, and what does it mean for further investment as well?
Okay, just minutes away from the opening bell, and also that conversation we'll be having with AmCham China. Going into the open today, futures are pointing higher. Banks, brokers, financials are leading this charge as we move into the open this Thursday. Good morning. You're watching The China Show.
And welcome back. You are, of course, watching The China Show. We're counting down to the open of markets and also just keeping an eyeball, if you will, on that. There's the CSRC Chairman Wu Qing talking about the various measures that they're announcing to boost long-term capital into the A-share markets. Dave?
Yeah, and hopefully incentivize a lot of the money that's been sitting out of this market so far to come back in a very slow, gradual, and sustainable way, I think is one of the key points that they're making there. To our viewers who are joining us right now, this is an ongoing briefing taking place in Beijing from various financial officials. Really, if you think about it, with the CSRC head there, perhaps the face of Chinese markets. Going into the open today, we're looking at gains just about across most sectors and most benchmarks. 0.7% to the upside on the A50. Hang Seng is up 0.5%. The open in the mainland is down. It's up there. There we go. About 0.9%. So these are fairly sizable moves that we don't normally see at this time of the day. So we are getting at least markets react positively to the lines that have come through so far out of Beijing. It's also worth noting that many of the things that they're unpacking right now were announced yesterday going into the latter part of the Wednesday session. So they're basically giving us a little bit more details on that. Markets are responding in the early goings. In fact, as I speak, we're now up 1% on the CSI 300. Most of your sort of heavyweights, bottom of your screens, are also moving to the upside. The Hong Kong story is this. We've been bobbing around at 20,000 handle for the better part of this week. We are just a little bit below that, as you can see, 19.9 on the Hang Seng Index. I think just to summarize this so far, it's really been an A-share market story, an onshore market story than it is any reaction in the offshore markets. Insurers have been front and center here. In fact, financial, generally speaking, so brokers, given their role, of course, in the system, insurers, given their specific role in boosting their equity allocations. In fact, just on that very note, Morgan Stanley put out this note I would say about an hour back or so, talking about how the impact on insurers would be that they will be taking a more gradual approach to increasing their equity allocations, given, of course, that is a sort of separate matching dynamic that they need to also consider, obviously, before they just sort of pile money back into the equity markets. Right. Other stocks that we're tracking here as well. So from the macro, very, very quickly, we'll go to the micro stories here. And this is actually a sizable move here in Henlius Biotech. This is down to Shanghai Fosun or Fosun Pharma, effectively coming out and saying they've terminated the plan to privatize the second company, although they are increasing the buyback for them. 2.5%. Chow Tai Fook is a retail sales story. They announced that. Double-digit declines. Same-store sales across their markets, Hong Kong, mainland China, and Hong Kong, of course, we're continuing to track that on the back of the story out of Panama. Anyway, we can get into that a little bit later on. Very quickly, speaking of policy support in a policy-sensitive market, we're looking at sports-related stocks. In case you missed that, let me just read that out. The State Council also put out a statement yesterday how China's aiming to build 100 high-quality outdoor sports destinations over the next 5 years or so. So again, underscoring this policy support for sports.
As well as right ahead of the Lunar New Year holiday, yes, when a lot of people are focusing on experiences, whether it's indoor skiing or the like, instead of spending on luxury items. You know, a key gauge so far this year on the A-share market of consumer staples is down 6%. So far year to date, underperforming the broader CSI 300. So this could give that a boost as well. So, all right. Dave, we're going to pivot here a little bit to get a pulse check on the Chinese economy from the American Chamber of Commerce. AmCham China has just released its annual business climate survey. It says U.S. companies in China reported mixed performance amid persistent bilateral tensions. Over half of its members are concerned about further worsening of U.S.-China relations. For more, let's bring in Michael Hart, president of AmCham China, who joins us from Beijing exclusively. Good to see you, Michael. So much happening in the world right now, domestically, obviously, in China, but look what's just happened this week in Washington, D.C. Give me your key takeaway from your survey that you've just released this minute.
Right. So good morning. Certainly the Business Climate Survey, which AmCham China releases every year, is our chance to take a pulse of what American companies are thinking. As you said, only about half of them report profitability in China. 18% of them report a loss, so that's concerning. And the number one thing that they're looking at is U.S.-China relations. And so we are very closely watching what's happening in Washington, D.C. with trade policy. A year ago, we knew that the Biden administration engaged through commerce and through Treasury with China. And the question is going to be, how does the new Trump administration engage with China? Because, again, for our members, they're saying that U.S.-China relations are very important. You know, many of our companies have been here for decades. They continue to say China is an important market. In fact, I think about half of them say China is still in the top 3 markets when they look at overseas investment. But a lot is going to hinge upon the politics between U.S. and China.
Michael, David here, just to pick up on that point you just made, I'm going to put the number out here. 51% of your members are concerned, to your point here, about this deterioration in U.S.-China relations. That's the highest level, in 51% in about 5 years or so. I'm wondering if you have any insights into what specific sectors that's most pronounced, and, you know, tangibly how, which sort of companies can feel those tensions the most.
Yeah, so the first thing is U.S.-China relations have been the number one concern for the past 5 years. So, you know, since we came out of COVID, companies here continue to be concerned about U.S.-China relations. The obvious sector would be tech. Tech is an area where the U.S. is concerned about certain exports. And so although tech companies, some of them manufacture here or assemble here, of course, a number of semiconductor companies continue to sell into the China market. And so for a couple of the tech companies, China is one of their largest markets. And of course, they're concerned about, which types of chips can they sell or not sell here. And so, China continues to be a great market for some of these companies, but those companies also have to make sure that they're, on the right side of U.S. policy.
Michael, the survey also revealing that 87% of respondents see positive bilateral relations as crucial to their operations in China. Now, I'm not sure what the time frame for this survey was, but clearly from your vantage point, were you relieved that Donald Trump did not necessarily put tariffs and that 60% threat on the front burner on day one and day two of his new administration?
So we did the survey right during the election. So a few people answered before and some post, although I think folks here, many of them expected Trump to win. And so I think a lot of that was baked into the results. You're right. President Trump did use tariffs his last term in office. We expect that will be on the table. It's been interesting. We did see within the last day and a half that the White House released their America First policy. And so the way we're reading that is they've asked many of the ministries in the United States, Commerce Bureau, Treasury, et cetera, to go back and look at trade in general, where trade is not fair or unbalanced with things like, the trade between the two, and also restrictions on companies for equal access. And so these are things that are very much at the heart of what AmCham China does with our business climate survey. When we ask members, do you feel you have fair access? There are certainly certain sectors where we don't have full access, and there are certain areas where companies feel like they're competing against Chinese local companies or SOEs. In some cases around government procurement, companies are trying very hard. For example, in the medical sector, they want to make sure they have access to sell into Chinese hospitals, which are largely government owned. And so this is an area where if our companies don't feel they're getting a fair shake, we can reflect that in the business climate survey. We can raise that to the Chinese government directly. We can also raise that to the U.S. government. And so hopefully when the U.S. does their assessment of trade policy, they take into consideration some of the findings from our business climate survey and what our companies are seeing here on the ground.
Michael, you make a very good point. I mean, these conversations with guys like you are extremely important because you give us really the details we don't necessarily see in the headlines. I want to get a sense right now, to your point, on market access. How receptive would you describe Chinese officials right now in those areas where maybe you feel access isn't as clear to your members?
Right. When we talk to the Chinese officials, I mean, their attitude is that the market is open, foreign investment is important, and the market will only be more open. So those are their talking points. And in many cases, they are trying to make sure that we have good dialogue with them. However, there are certain sectors around technology, around healthcare, where our companies feel like they aren't getting necessarily full access. There's a concern that there might have been, a whisper campaign to buy local and not buy international. And if that happens, we will see a decline in investment from U.S. companies. We don't want to see that. We think, China is the second largest economy in the world. We think the U.S. should be here, should be playing here. We think that helps U.S. companies and the U.S. economy for us to be engaged here. There's a lot of innovation going on in China, particularly around EVs. And we think that U.S. companies in China, number one, allows us to compete and sell into this market, but it also gives us market intelligence about how things are evolving here in the world's second largest economy.
Well, how does that play then? Obviously, you just mentioned EVs. I mean, General Motors is perhaps going to write down some of the investments. They're losing money in China after seeing it as being kind of a cash cow for quite a number of years. But a second part of that question, too, is the depreciation we've seen in the renminbi. And what does that mean for capital allocation in China instead of possibly taking money out of China in a deflationary and depreciating yuan environment?
Right. So in terms of the actual, RMB US dollar exchange rates, we don't take a position on that one because if it goes up, it helps some companies. If it goes down, it helps others. But certainly the Trump administration will be looking at that from a macro point of view. And they're very concerned about, is China, changing the playing field in terms of trade. So we do know that in the last administration, one of the things in the phase one trade deal was President Trump was trying to make sure that the Chinese were buying a lot more from U.S. companies. Of course, we appreciate any chance to sell more into China. We hope it's because Chinese consumers see our goods as some of the top in the market, and they want to buy them. And so this is where market access is really important. Again, where we go from province to province and meet government officials and say, how come U.S. companies aren't winning these bids? In many cases, companies have made the investment here in facilities to produce here for China. And in fact, when we look, most of our companies are producing in China for the China market. And so we definitely want to be able to see a return on those investments. And we want American companies to have a fair shot. And again, that's one of the things we try to highlight here with our business climate survey.
Michael, just to borrow the word you just used there, return. Can you give us any insights into, people-to-people exchanges are very, very important with this relationship. And I'm wondering, do you have any insights into hiring and bringing more American expats back into China?
Yeah, unfortunately, that's a trend that I think is not going to rebound. It looks like most of our companies have localized positions. And this is actually, in some cases, a weakness because if you're in a tough position, and China's been in a tough space since COVID, you certainly need folks in headquarters back in the United States who have China experience. And so as jobs have been localized, you get local expertise, but sometimes you lose the ability to have someone, at headquarters who did a tour through China. And so one thing that's really important is to get corporate leaders coming back to China. We have slowly started to see some students return, some academics return, and some business leaders return, but not nearly enough. And government officials, there's not been many at all. I think about a year and a half ago was the first Senate delegation, but vast majority of members of Congress who are sitting now have never been to China while they were members of Congress. And this certainly also colors how Washington, D.C. sees China. Again, we'd love to see more corporate leaders coming. We think in the spring, when there's a conference called the CDF, the China Development Forum, there will be some leaders coming to visit. But it's absolutely critical that we get folks out to China to see what's actually happening on the ground, because it continues to be an important market, not an easy one, but an important market for U.S. companies to compete.
Michael, in 10 seconds or so, would you like to see Donald Trump come?
Sure. If he can make that U.S.-China relationship look better, that will certainly help our companies and how they're perceived in China.
Michael, fantastic. Thank you so much for taking the time. Michael Hart, there, president of the American Chamber of Commerce in China, joining us out of Beijing. So breaking news here, Steve, and this goes back to the other big story we're tracking here, the spat between Elon Musk and some Altman on, some of these companies don't have the money. And I think we now have a little bit more detail on the funding situation
we're
here.
Seeing a headline come across that both OpenAI and Softbank have each committed at least initially $19 billion to this Stargate program, which Elon Musk has criticized a bit because he's saying these companies, whether it's Oracle or OpenAI or Softbank, don't have the capital base necessarily to put this in to this program, which could potentially stall it. However, Sam Altman has come out and said that is wrong. And so, a little bit of a feud going on there.
Yeah, there we go. In fact, you can turn to Twitter or X for more on that feud taking place, public feud there. Very quickly, Chinese markets are bid substantially as we speak in reaction to the live briefing still ongoing in Beijing. Massive rally we're seeing here across these Chinese markets. On price itself, we'll see if it lasts, and more details coming through shortly out of this briefing. Stay tuned. This is The China Show. Right, welcome back. So just a brief look at markets right now. We're coming off a little bit of highs right now here in Hong Kong. Speaking of the stock exchange here, so we had a conversation with the HKEX chief in Davos where effectively Bonnie Chan told us 100 IPOs are in the pipeline for this year. That's after a bumper 2024, which actually saw a 90% jump in money raised from new listings. I think we buried the lead there from a fairly low base in 2023. Anyway, the momentum is with us here. Here's Bonnie Chan.
And in any event, I think the market it's getting used to sort of having surprises sprang on it. So I don't worry, really. The momentum overall is quite good. And we're at Davos. I've been speaking to a lot of people. Obviously, the topic of U.S.-China relations come up in lots of conversation. I would say that generally there is quite a bit of optimism expressed. So still early days. We're in the third week of the new year, but so far the Hong Kong market has shown great momentum in terms of volume. Last year we closed the year with ADT of about 132 billion. Year to date, we are already up at 150. So, yeah.
The optimism is driven by prospects of stimulus from China.
Yes.
But with drip kind of tariffs, some say that, the massive stimulus that we're expecting from China may not happen. I mean, how are you assessing prospects of stimulus and how that might play out into the markets?
Okay, I think the spectacular moment, shall we say, obviously came after the September 24th announcement of the stimulus package. And we saw the market reacting in quite a strong manner. In fact, in Hong Kong, in the course of 2 weeks, we broke our ADT record 3 times. And the current record is 620 billion. And that's about 6 times what we did in the first 6 months of 2024. I remember, when we were seeing that play out, a lot of people were asking, okay, so when is China going to bring out the bazooka? Remember the bazooka? My personal reaction to that is I don't think, the Chinese leaders are going to just sort of, bring out one set of stimulus and say, that's it, we've cured all problems and that's the silver bullet. I do think that they're very thoughtful about the issues that have to be addressed. And as a result, and especially given how dynamic the market conditions and the macroeconomic conditions are, I do think that we should expect to see more thoughtful rolling out of different policies, which will be targeting the questions at hand.
And Bonnie, what's the outlook for the IPO market? Quite a turnaround in 2024. I mean, yes. Hong Kong was top 4 in terms of IPO market.
Yeah, thank you for asking that question. So the IPO market. We saw a very good comeback in 2024. So in terms of number of IPOs, we completed 71, which is by and large, the same level or the same number in 2023. However, the amount of fundraised was 90% more compared to the year before. Also, we are seeing very big deals getting done.
And that is Hong Kong Exchanges and Clearing CEO Bonnie Chan speaking to our very own Haslinda Amin in Davos. We have more interviews out of Switzerland later today, including with NATO Secretary General Mark Rutte and also Morgan Stanley CEO Ted Pick.
Okay, about just over 20 minutes into the cash market session, I think long story short is we're doing much better in the Asia market. We're doing decently as well in Hong Kong, although we're coming off highs, as you can see on your screens. We're back below 20,000, but you know what? We're seeing gains this Thursday. Plenty more ahead. Right, welcome back. Our top story this hour is this ongoing and quite a rare briefing that's begun before markets got up and running, which is obviously a sort of a step back from the usual norm of briefings that start later in the morning. So far, markets have listened. Mm-hmm. You see that on your screens with some of the, and what are we looking at here? These are some of the sports-related stocks, which is, I guess, a complete different story. Can we get the insurers up, please? It's not this one that we should be looking at. In any case, of course, we're looking at some decent gains across equity market. You just have to trust me on that. Or you can turn to your terminal or your Google if you don't trust me. Some lines coming through out of the PBOC deputy, PBOC official here at Zolan talking about how the PBOC will be expanding tools to support the market at an appropriate time. So they've actually come out, Steve, with some lines here to support the markets.
Yeah, and we should bring up those insurers because one of the lines that kind of got buried in the headline flood is China's big state insurers to invest some 30% of new premiums into stocks. So they're trying to attract more of this domestic institutional long-term capital into the stock markets for longer-term benefits, obviously, and stabilization, and remove some of those bottlenecks for the introduction of such longer-term capital, Dave.
I think the point, you're right, the point that our guest this hour, Tai Hui, made was a very salient one, given where China wants the market to go. Obviously, they want the market to do well. The role of institutional and patient money will sort of take the edge of the massive ups and downs of this market and provide really an anchor for the equity market.
Well, absolutely. It's a highly retail-driven market, A-share market in China. So to get more institutional money, longer-term capital, deeply rooted there is a long-term trend, obviously, by the government in wanting to facilitate that and incentivize that, Dave.
They will. And yeah, I mean, the incentives have to be in place. Short-term, it's earnings, the economy, and the return of inflation, which would incentivize money to come back to this market.
Right?
Yeah, that age-old argument, of course. Plenty more ahead here on the China Show. The second hour is coming up.
And welcome back. You are, of course, watching the China Show. And also, we are watching CSRC Chairman Wu Qing there, Deputy Finance Minister Liao Min, and Central Bank official Zhou Lan holding a briefing in Beijing, getting kind of a jump ahead of the big Lunar New Year holiday as well, as to shore up the markets, the A-share domestic markets, which have been down 3.5% before today's slight rally. Year to date, down 11%, Dave, since October 8th high. And then we saw that first round of stimulus sort of peter out. But since February 10th of 2021, the market is down 35%. They're trying to attract much more long-term capital and get big state insurers to invest some of their premiums, upwards of 30% of new premiums into the A-share markets, and put a bit of a, at least short-term, floor on this rough start to the year, Dave, for domestic on-share markets.
I think it was the worst start in nearly a decade, I think.
Yeah, since 2016.
Since 2016. I think, in fact, 2016, you remind me now, it was in January of that year. Okay, so let's rewind a little bit right now. So August of 2015, well, no, let's rewind a little bit further.
Currency shock.
Was the currency shock, which was weeks after that boom and bust in the market. Yeah. And then they moved into currency again, I think again in January of that year, which I guess underscores the sort of extraordinary move we've seen this year comparable to that point in time. What we are getting, as Steve was pointing out, is some of the incentives that they're putting in place to unlock quite literally the doors to the market for some of the longer-term capital. There's a note out of Morgan Stanley. I'm just going to bring that up right now, just so if I can bring that up right now. That's on the note on insurers increasing their allocations into the equity market. It will take time for these companies to lift their equity exposure. Because we recognize that insurers' investment behaviors are prudent and solvency ratios remain a restriction. And certainly, it would be hard to imagine insurers being tactical, short-term tactical as far as the conversation goes. Anyway, we will keep you on top. We'll be on top of the briefing and any further headlines coming through for our Bloomberg clients, TLI Vigo, in case you want to stay a little bit more on top of this. The other market reaction to the point we were making is along the insurers. There we go on your screens. I have my glasses, which is counterintuitive because I can't see anything. These are the insurers, yep, on your screens. Asia ex China, the market moves of late have also been good, actually. So the dollar is actually, after a slow start to the week, has actually come back a little bit in terms of strength. We did almost close at an all-time high on the S&P futures, so it just suffice to say, it feels like it's just a matter of time before we take out a new high there as we move into earnings season. We're flat across the Asia Pacific right now, and U.S. in 2 and 10-year yields on your screens. As we were just pointing out, the dollar is on the stronger side of things, and a look at majors right now ahead of some key central bank decisions, by the way, coming through on Friday. So I think we have the Monetary Authority of Singapore coming out, and also, of course, the BOJ around this time tomorrow. Okay, that's the market story for now. Let's get a sense of the outlook and where we go from here short term. Monica Hsiao is with us here on sets, founder and CIO, credit asset manager, Triada Capital. Good morning.
Morning.
You want to start with China, or do you want to start with the U.S.?
Whatever you like.
China. The jury's out whether this is able to boost sentiment short term. It is currently today. And I'm wondering, is there anything else that hasn't been said from regulators?
Well, I would say, is it? Because, we came off of a very strong overnight. So typically Asia equities would follow that anyway. And I think that we've seen over and over again, any of these sort of short-term boosts to sentiment doesn't necessarily lead to a sustainable rally. And, at the end of the day, to bring back sort of animal spirits, we have to have something that is a game changer. And like with any equity of any region, you need a belief in the underlying fundamentals turning. And we just haven't seen the signs of that quite yet.
Is the tide in the United States just too strong right now with the S&P 500, another record high? Obviously, there's a bit of a pause, perhaps, with the Fed not cutting further anytime soon. Does that kind of make it much more difficult for those officials we're seeing in Beijing saying, hey, come to the A-share markets here in China, invest here?
I mean, sure, there's been divergence of the relative global demand of where the funds go, but that's been for a while now. So I think from here on, it really is about, first, I guess my overall view is that for at least the first half of the year, we have the makings of a perfect backdrop for the Goldilocks scenario to continue, and that's for all risk assets. And then secondly, really, as we all know, everybody's so glued to sort of everything that Trump is saying about tariffs. And ultimately, it's what I've always said, which is that with Trump, it really is about looking at what he actually does, what actually gets implemented. Anything that he says, just like, prepping the whole market to think that Inauguration Day we're going to get some day one tariffs, it didn't happen. Now, February 1, that he keeps getting touted as, when he's going to introduce the next, phase, it's may not happen. And so I think the irony of it may be that, the first half of this year, maybe the story isn't going to be about tariffs. And I think that's something to consider as well.
Do you get a sense that this softness in the dollar is temporary?
Yeah, definitely. I think that the theme of the dollar being higher for longer is definitely intact. We are well off of the 110 plus on DXY, but I think that it's really just each time giving people the chance to reset that trade. That said, it's heavily positioned, obviously, so that's the danger there. But yes, I think that not only do you have American exceptionalism as far as the productivity outlook, especially with the investments in AI and so forth, but you really see the underpinning in the data itself. In the U.S., the economy is quite still relatively strong, and the perfect setting is actually for earnings to come off slightly, but not a lot. And then that makes, sort of the rates range bound as far as traders' implied, yields go.
Looking ahead to the National People's Congress, people are market participants pinning their hopes on some sort of fiscal stimulus, other kinds of stimulus. We've been disappointed so far in a number of different statements, if you will, and pledges. There's kind of policy promise fatigue, right? I'm just curious how China will address the overwhelming deflationary spiral that they are in right now, and how much tolerance they have for leveraging up to combat that.
So I think that's really the interesting perennial question for the last 3 years now is when are we going to get a fiscal stimulus of a size that we would call, game changer, bazooka, if we will. And, I think that now I've come to the view that we're not going to get that. So you're not going to get one huge stimulus. But now the question is, if they can do that, when would they do that? And it would make sense for them to wait until the shoe drops as far as, the tariffs, right? So I think there's that. But then the other thing is really, to your point, how much can they really do? I think is a question mark based on how they might see things. Because leverage right now, we're looking at leverage continuously going up, even without a bazooka, just even with sort of, bits and pieces of the fiscal stimulus. We're, at today, when you look at last year, the leverage growth has mostly been in the public side, i.e. the government bonds, both central and LGFE. So we're not seeing any of the stimulus today actually impacting the per capita consumption expenditure growth. And that is the key. That is the real problem here. China has had ambitions to change the structure of the economy towards, consumption-led, and that's not happening right now.
Should we expect that trend to continue? More of the debt to come into the public sort of domain, and do rates counterintuitively? As they up their game on stimulus and debt, do rates continue to fall?
I think that policy rate will continue to fall. The issue is that marginal impact is minimal because, as we were discussing, it's really about fiscal stimulus now. Monetary impact, you don't even see it feeding into the lower cost of funding for most corporates, because actually from the bank's perspective, the all-in funding cost is still relatively high. And so, also coupled with challenges in profitability in general, companies are not having the appetite to ask for more debt. So I think that is one of the issues. And then also even at the household level, we have 6 sequential quarters of mortgage demand falling. So, all of this, goes back to Stephen's point about a spiral. I think we are in a spiral still.
To David's point about the king dollar and the legs that it potentially could have, what does that mean for the renminbi? We've heard from Pan Gongsheng essentially talking up needing stability in the renminbi, but at a time when exports are the main pillar of strength right now, you kind of need to be able to give them something as well to weather the tariffs and to weather this discrepancy. Would you expect further depreciation, or are they going to keep on trying to hold up the value of the renminbi?
So I think this is really about timing. In the phase we're in right now, I would expect the renminbi to be in that range of like 7.25 to 7.35 area. And I think mainly because it makes sense for them to intervene to keep it stable and somewhat resilient until they kind of are clear in how the negotiations go with Trump. And so it doesn't make sense for them to trigger anything that looks remotely like hints of a currency war for now. And then, ultimately, if we're talking about the massive sort of tariffs that people were fearing before, then, you could see it go to, I think, 7.6 area. And so I think this is really a matter of leverage on all sides as far as, currency. In fact, I would say that, there's a lot of, obviously, we're going to be focused a lot on rates, yields, but I think currency is just as important for this year, especially with, the trade talks.
What else is top of mind for you this year? Tell us anything.
Anything.
Yeah,
well,
anything and everything.
I guess one thing we haven't touched upon yet for this week is BOJ.
Okay.
I think I'm quite interested to see if they give indication as to why they made a change. From December, everybody thinking they're going to hold, thinking that maybe March will be the first time they hike, to now, pricing in over 95% that they're going to hike 25 bips tomorrow. I think the why could be interesting because, Besson did make some comments about wanting to see them normalize faster. So, whether it is because of that or because we all know that wage growth is going to be up another, 5 to 6%, and they can normalize. So it'll be interesting to see that. Obviously, you see the reaction in the markets, which is, it's a snooze. And, I think the yen will still be, a funding currency. Long end JGB yields are starting to catch up more with the euro side, but, it's still a cheap currency. And we, I think interestingly, we haven't seen really much positioning of inflows into JGB at all. So that's something to watch. But I think for this year, it really is, I think, for now, a tale of two halves between the first half of the year and the second half. It's going to take a while for implementation of tariffs, I believe. And the date to really watch is probably more April 1st if you're really, kind of that focused about tariffs, because Trump is ordering an investigative report, right, into the bilateral relationships. And so, I do think now we are really moving away from having much fear of a global sort of set tariff. It's going to be targeted. And then, the focus really should be on the fundamentals of earnings warnings of inflation, which I personally believe will be in check for now. The interim sort of volatility from, tweets or just general sort of talk, that will cause short-term volatility, but I think it's just going to keep giving people the chance to reset longer themes.
So pretty much a dovish hike tomorrow from the BOJ, right?
I think so.
Yeah. All right, Monica Hsiao, founder and CIO of credit asset manager Triada Capital. Thanks so much, as always, for coming in. All right, coming up, SK Hynix posting record quarterly profit, powered by what else? AI. We'll dig into the outlook for the company and the sector next with Bloomberg Intelligence. You're watching, of course, The China Show.
Welcome back. You're watching The China Show. We're looking at some of the semiconductor bigwigs in the region. Apart from TSMC, at least on your boards right now, SK Hynix and others are actually down, and certainly the story is out of SK Hynix. Despite record profit, we're down 3%. That's actually dragging down the entire Korean market today. By the way, that record quarterly profit is thanks to its laden advanced memory chips for data centers and AI development. Certainly, if you could think about that almost as a proxy for the NVIDIA trade, when you look at the operating profit, I think came in $5.6 billion, 75% rise in revenue. Imagine that. Let's bring in Masahiro Wakasugi, our senior tech analyst out of Bloomberg Intelligence, to talk us through these numbers. Yeah, what did you make of the numbers, and also why do you think the markets are reacting quite negatively here?
Yes, actually, if we look at the revenue and the operating profit in the December quarter, Q4 were almost in line with expectations. So in that sense, we didn't have a big surprise. And maybe the company's guidance for the first quarter bit shipment for NAND and DRAM is seasonally weak. So it's not surprising, but it's not strong for the the guidance. So maybe leading to the share price reaction. But if we look at the Q4 results, that was pretty strong, and the operating margin achieved 41% for overall company, and meaning that probably we estimate that DRAM operating margin was around maybe 50%, and NAND flash about 10 to 15%. So, and SK Hynix HBM revenue grew almost 4.5 times in 2024, and HBM revenue representing almost more than 40% in Q4. So that's a pretty meaningful result for SK Hynix.
Masahiro, that leads to the next question. How sustainable is that? What's the market expecting for high bandwidth memory? HBM, obviously, as you just mentioned, it's been powering all the news flow in AI that we've had this week, and it's been powering these memory chip makers. Is it sustainable?
We think it's sustainable for a while. And at least the company is expecting 100%, almost doubling revenue growth for the HBM products. And that's based on the long-term contract. And if we look at the hyperscalers, CapEx, or their earnings, probably the AI investment will continue going forward. And we have quite many social issues which could be resolved by the AI technology going forward. So at least we expect the AI investment to continue going forward. And probably SK Hynix will be in the leading position for the HBM3 or 3E, and also could be HBM4 going forward. So in that sense, probably the NVIDIA or SK Hynix could be the major maybe solution provider for the AI technology development going forward.
All right, great stuff. Masahiro, Bloomberg Intelligence Technology Senior Analyst Masahiro Wakasugi, thanks so much for joining us. Here are some of the corporate stories we are also following this morning. Bloomberg has learned that Google is backing AI developer Anthropic with an additional $1 billion, building its stake in one of the most promising rivals to OpenAI. The new funding comes in addition to more than $2 billion that Google has already invested. Meanwhile, Anthropic CEO Dario Amodei says the Stargate AI infrastructure plan unveiled by President Trump appears, in his words, chaotic. Data software provider Databricks says it's raised more than $15 billion from companies including Meta Platforms and the Singapore and Qatar investment funds. Databricks is one of the world's most valuable privately held tech companies, and one of the few of that size that's avoided an IPO. Its latest private funding round was a Series J, much further into the alphabet than most startups ever reach. All right, plenty more ahead. This is Bloomberg, and you're watching The China Show.
Welcome back. You're watching The China Show. President Trump is threatening financial penalties on Russia if Moscow doesn't end the war in Ukraine soon. In a Truth Social post, he suggests President Vladimir Putin should make a deal or face additional tariffs and sanctions on Russian imports to the U.S. Now, Trump campaigned on promises to end the conflict that began with Russia's full-scale invasion in 2022. Now, speaking of, Ukrainian President Volodymyr Zelenskiy says any effective peacekeeping force in Ukraine must include U.S. troops, as the backing of only European allies, he says, won't be enough. Zelensky spoke exclusively with Bloomberg at the World Economic Forum in Davos.
It's great if we will have troops, but we have to understand that the troops will not be in the center of the capital. Yes. They will not have relaxed time. Yes, it's very important, because I heard that some allies said that, yes, but it's okay, we can be in the center of some city, and then no, we don't need such contingents. No. Yes, with our people, of course. Yes, because this means security, and that's it. So, but it can't be. It can't be without the United States. I will explain you why. Even if some European friends think that it can be, no, it will not be. First of all, nobody will risk without the United States. The second, that's what can divide NATO, divide EU and USA. That is a goal and dream of Putin, to divide this unity.
You mentioned China. How important is China in these negotiations? I mean, China is the backer of Russia. They seem to have had an impact on things like Putin not using nuclear weapons, those sort of things. Can China push Putin, and do you have any contact with the Chinese?
I had some contacts with Xi Jinping. We had a phone call during the war. Not too much, not enough, I think. Yes, he can push Putin to peace, I'm sure. I think that only President Trump is the strongest, and Xi Jinping. I think that there is no other allies who can really do it. Yes, because his economy, Putin's economy, after sanctions, after everything, depends very much of China.
You would like Donald Trump and Xi Jinping of China to work together to push
I think
push
yes.
Putin.
Yes, but not without us. It's important.
That's Ukrainian President Zelensky there, speaking exclusively at Davos with Bloomberg's editor-in-chief, John Micklethwaite. All right, let's take a quick market check. Obviously, some movers in South Korea right now. SK Hynix is at the top of the list there. This is an amazing story. The company reporting a 2,000-fold jump in operating profit, a 75% rise in revenue, and investors were disappointed, Dave. Of course, they're driven by strong demand for high-bandwidth memory, HBM chips used in AI applications going forward. And Samsung Electronics also in focus. As you can see, it launches a new Galaxy S25 phones. And Softbank continues to be in focus there. Of course, that OpenAI, Softbank, each committing the news today, $19 billion to Donald Trump's Stargate data center venture that was announced yesterday. Let's change the page. Dave, do you want to talk about some China brokers and insurers?
No, I don't want to talk about it. No, I will. Okay, here we go. So we understand that the briefing just ended, of course, over in Beijing. And really one of the key sectors that has sort of moved along those lines are the brokers and financials. In fact, on the other side of this break, we'll be getting Bloomberg Intelligence for their initial take on what this means, both for the market and the companies themselves. We'll leave you with a look at how Chinese assets have so far fared on the back of the lines coming through. And I think these two things tell you everything you need to know. Chinese assets have effectively reversed most of the early gains. Plenty more ahead. This is Bloomberg. The news that broke.
All right, it's 11:29 a.m. in Tokyo. About to see all the businessmen and women to head off for lunch. Japanese markets going on a break in about a minute. How are we doing there, Dave? My eyes are not so good. Nikkei 225 up about 0.5%. The broader topic's 1/3 of 1%. And, you know, we've just seen that dollar-yen 156 has been hovering there ahead of course, what we're expecting, widely expecting, a dovish hike from the BOJ tomorrow.
Yeah, you're asking the wrong person because somehow I haven't gotten the proper sleep this week. And, you know, this weather in Hong Kong, which is actually has been, it turned warm for about a few hours and then it's slightly back on the colder side. So it's drying my eyes a little bit. In fact, I don't have my contact lenses on today, so I have my pretend glasses on, so which is not really helping things. 156.48. I think if we could ask someone to move our screens a little bit closer for
Wait till you're my age.
The elder men here on set for us. Anyway, I've been losing sleep over the BOJ. What are they going to do tomorrow? Asia is looking like this. Well, a couple of stories, right? So you have obviously the latest lines coming out of China and the lasting effect it's had largely in some parts of the market. Most of the gains have actually gone away. It is, just to underscore the other point, though, a longer-term story as it pertains to incentivizing more inflows into the market. The other thing that's come back, really, and I think to the detriment of most parts of the region, is really a stronger dollar and how quickly that dollar softness did last as well. Apart from this, we're also monitoring other big market stories out there. In case you missed it, Donald Trump is president again in the U.S. And really one of the big announcements which came, I think it was 24 hours ago, was really this push into AI and the massive amount of money that they're committing towards that as well. And the question right now that's come of late, the chapter 2 to that story, Steve, I think was the spat between Elon Musk.
Well, Elon Musk is questioning whether these participants who are on the podium, you know, OpenAI in particular, Oracle probably has money, but Masayoshi Son and SoftBank, do they have enough to fulfill? And those two, essentially OpenAI and I believe SoftBank, talked about injecting $19 billion each into this Stargate.
Yeah, was the latest line, which came, I think, about an hour back. In fact, let's get the details and get us up to speed on this story. John Harney, our news editor, is joining us right now out of Washington to talk us through this. So, yeah, John, they seem to be fighting over or spatting over the amount of money each side has. Do they have the money?
Well, possibly, but it's not really. I don't think it's really so much about that. I mean, you have this squadron of business executives in the technology and other industries flocking to the side of Donald Trump, and that's been presented as an affirmation of his second term. What is sort of left out is that many of these people are competitors. So when Elon Musk said that he didn't think that Oracle and SoftBank and OpenAI had the money, I mean, Sam Altman of AI clapped back, saying that Musk was upset because this venture that Trump presented with Donald Trump presented with great fanfare could outshine him.
Yeah, it's an interesting dynamic to see, considering Elon Musk supposedly has the ear of Donald Trump, so whether he feels slighted or not. You're also listening in there to Donald Trump's lengthy interview with Fox News. What's standing out?
Well, I mean, this is all part of, again, with as with the prominent business executives, the signing of the executive orders at the Oval Office not long, hours after he was inaugurated. This is all part of the preparation that a hallmark of the second Trump administration. So this was his media debut, if you will, with Sean Hannity of Fox News. And it was, as with most interviews with Hannity, it was pretty complimentary, although, Hannity asked some, some provocative, not provocative, but, some, several serious questions. But that contrasts sharply with the interview with David Muir of ABC in 2017, shortly after his first term began, that quickly became pretty heated with Muir asking many questions about immigration, about the border, about claims of voter fraud, etc. This time with Hannity, the border came up. And it was, it was Donald Trump presented himself as the rescuer of, from the policies of Joe Biden, which he says has put the country at great risk.
So maybe not the devil's advocate coming from Sean Hannity, but obviously he picked a familiar person to be interviewed as the first interview on television after that inauguration. John, thanks so much. Bloomberg News editor John Harney joining us there. Well, in other news, the CEO of chip designer ARM says the multi-billion-dollar AI initiative unveiled by President Trump has solid financial backing. Renee Haas told us more about the infrastructure plan known as Stargate.
ARM will be the CPU of choice, if you will, inside these AI data centers. We power Grace Blackwell, which is the NVIDIA product that will be used, but lots of opportunity for all kinds of ARM technology. But most importantly, the CPUs that power Stargate, they'll be ARM.
So already, as you say, integrated into Grace Blackwell. What sort of innovations could this stir on your side? What way will we see your designs progress into this supercomputer and more to come, maybe?
$500 billion of investment and multiple gigawatts of energy require incredibly efficient processor solutions. So I think as we go forward, as these plans get more and more defined, I think there'll be more and more opportunity. But right now, we're super excited to be involved with NVIDIA and Grace Blackwell.
I think that's so key as these plans get more and more defined. These are, at the moment, pretty new announcements coming, but people questioning how new the ultimate decision to spend has been, because we already had Massa, of course, this leader of Softbank, which in many ways owns a large part of ARM, talking about this $100 billion investment in infrastructure in the US, but a few weeks ago. How long has this been in the making?
These discussions have been going on for many months. Something like this does not happen overnight. I think the world has seen that to reach AGI or ASI or some of the capabilities of artificial intelligence, a tremendous amount of capital is going to be required. Obviously, a lot of power is going to be required. A lot of compute is going to be required. Massa has been looking at this for quite some time. We've been talking to the OpenAI folks and Oracle and MGX and Microsoft and NVIDIA. So I think what you're seeing that just came together was the culmination of all those conversations, but it didn't happen overnight for sure.
Does it have the money? I'm afraid some shade being thrown on this project by one Elon Musk. Do you have anything to provide? I know you're the technology partner, but what about the capital?
Yeah, I haven't seen Elon's tweet, although I certainly have heard about it. There is a lot of backing for this, Caroline. Believe me, it was not taken lightly to make the announcement yesterday at the White House with President Trump. So I think you can feel pretty good that the financial backing behind this is quite solid.
And that was ARM CEO Rene Haas speaking exclusively, speaking with us, of course. Caroline, hi there, of course, our co-anchor. If you are a Bloomberg subscriber, you can catch all the interviews you might have missed here on our interactive function, TV Go, and also join the conversation by sending us instant messages on our shows. We've been covering a lot of stories in the last, 90 minutes or so, including, of course, this briefing, which ended about 30 minutes back over in Beijing. So plenty more to sink your teeth into when you look at that. And as we look forward, plenty more stories. We'll unpack the market story in China coming up next. This is Bloomberg. Right, welcome back. A market update here, and I think this visual tells you everything you need to know about the morning so far in Chinese assets. We started out quiet. There was a lot of expectation going into this live briefing, which did deliver in terms of some of the longer-term incentives, and we are seeing that show up in parts of this market. Although, as you can see here, the weakness has returned in the currency, and the equity market, as you can see, is also coming off almost a mirror cross-asset image there of highs of the day. Now, one part of this market that's doing extremely well, CSI 300, a glance at the sectors on your terminal, financials are up over 2%. Most sectors are still up, as you can see. In fact, when you dig deeper into the financials index on the CSI 300, next page, please, and you get a sense of what's really leading this, insurers and brokers towards the bottom of your screen. So it's been good if you've been long this specific sector. Let's bring in Abhishek Vishnoi, our senior equities reporter, to take us through the commentary on this market so far, Abhishek. And yeah, like what's your team discussing at this point?
Well, it's been a volatile start. It's on expected lines. We were not expecting a bazooka sort of announcement from PBOC, CSRC. We were expecting more details to trickle in. But this is a net positive move. It just shows that whatever positives, incremental positives come in, the backdrop is still of US-China tensions, which may escalate very quickly. The backdrop is still about China's slowing economy, China facing deflation. So those things needs to be addressed for these measures to actually become a force and become more than a tactical trend. Right now, what we are seeing, from our reporting is some brave hearts are going in and increasing exposure, but these are very tactical bets which range from days to weeks, maybe just ahead of CNY, they can get unwinded, or just ahead of the 2 sessions in March, they can get unwinded. But it's not a tactical trend yet. But it's always good to have these deep-pocketed investors committing a lot more capital to stock market, and that's why brokers are excited. That's why pension insurance stocks are also excited. I mean, they can manage their liabilities better. So incremental positive, but the long-only investors are still waiting for something more material to come in. I mean, this is to say that market does not want these guys, policymakers, to miss on stimulus, and markets would really want Trump to continue to talk softer about China-specific tariffs, as he has been doing.
So again, they're trying to attract long-term capital, and they get the insurers and state-owned enterprises funds to invest in the market. But these insurance companies have been fairly prudent, I guess, with their equity exposure. So the stock market is approving of it right now. Investors saying it's a good thing for insurers. But longer term, is this the right thing for insurers as an equity play?
I think it is the right thing. I mean, my colleague Sangmi got some reporting, and it puts the logic nicely. I mean, the insurance products itself, they are yielding very low because of where stock market is. And if stock market does good, manage a high valuation, they'll start yielding better. And insurance and pension guys will be able to manage their long-term liabilities better. Look, think about it this way. As an insurer, as a pension fund, you are supposed to manage long-term liabilities. You're getting China at what valuation? At a very low valuation. So if things don't escalate in US-China tensions, or if the narrative gets managed well, there is a chance that the long-term liabilities that these guys need to service, it gets managed very easily. So, that's what the sector is reflecting right now. And look, it has played out in other markets as well. We have seen Japan's GPIF, owning a very big portion of the market. We have seen Philippines actually trading at very high, possibly the most expensive market in Asia for a long time, just because deep-pocketed investors like pension funds, insurance funds started investing a lot more in the market. 60% of the turnover in the market, in China market, is retail. Retail is still hesitant. So, this is good. This is long-term good for markets and good for the industry, for pension and insurance funds.
Abhishek Vishnoi there on the initial commentary, of course, on these market moves out of Singapore first. And I think the point Tai Hui was making, our guest earlier on out of JPMorgan Asset, was retail is a feature certainly of this market. You do need the anchor from the institutional money to sort of to smoothen out and blunt some of the ups and downs of this. Insurers, we were talking about that. I think we're looking at gains still. We're going to show it very, very shortly for you. The other part of the conversation, though, is with a 30-year yield at 5%, doesn't that in many ways also match those longer-term liabilities if you're sitting on a longer-term portfolio? Anyway, to help us answer that question, Stephen Lam is here with us on set, Bloomberg Intelligence APAC lead insurance analyst. You put out your initial take on what's been said so far.
Yeah, so there are two angles to this. I think everybody heard about the 30%, but I think we need to clarify the definition, what it means by new premiums. That's exactly what they say. Now, we don't have a full detail yet, but my understanding of new premiums mostly talking about life insurance, new money that came in, not the renewal premiums. So to give you a perspective, so let's say if we take 4 trillion yuan of life insurance premiums a year, okay, not the 30% of that going into stock market, no. It's about the 30% of the 30% of that will go to the stock market. So we crunch some numbers, right? Basically, if we take 30 billion incremental US dollars worth of money can go into the stock market, not bad, right? Probably a few percentage points in terms of the local turnover or what have you. And, another side of the coin, it's why they want to do that. I don't think it's just because they want to boost the stock market. That's obviously a good thing. But more like to what Abhishek was talking about is the product structure, because the country is facing very low bond yields, so it's not sustainable to sell short-term savings products, right? So they have to go to long-term policies like participating policies. Now, those policies by design are supposed to have weights of 30, 40%, or even 50% in terms of equities at some point. Now, these could be tactical moves. It's not like you have to stick with that for the whole duration. Probably you can add, you trim. But the focus is that this outstanding amount of equities is about 4 trillion holdings, about 4 trillion yuan right now. Now, give or take, that's about 13% of the total investment they have.
Right.
So, yes, in the very long run, you're moving from 13 maybe to, 20 or 25%. But I don't think the goal is to move the whole book to the 30%.
Right. So in the short time, the portfolio of A shares could grow. But is this something? I mean, yes, it's being mandated by the government.
Yeah.
But is this something that would be prudent to do in a market that has been down considerably? One of the worst starts, obviously, in almost a decade.
So if you remember, one of the details is actually talking about the assessment by the Ministry of Finance, which is essentially the owners of these state-owned insurance companies, that they reviewed the KPIs were like ROE or net profit and things like that. Used to be a very short-term period, so every year they have annual review. Now they're stretching out to 3 years or average of 3 to 5 years. So it gives them the wiggle room to, if you have a down year, that's okay. And even for the policyholders, these policies, when you buy them, you don't intend to take the money out in 10 years. You intend to sort of keep it with them, the insurance company, 15, 20 years before you can see the impact.
Yeah, I'm glad you brought up the finance ministry angle there, because I think that the other big picture here is they are also when these insurers and the banks in particular also issue the dividend, it also goes back to the state, doesn't it, in terms of the profits, right?
Exactly.
The other question I have is, if it's not in the equity market now, where is that money? Where is it allocated right now?
So very good question, David. Now, you guys look at the China bond yield pretty much on an hourly basis, right? It plunged to, below 2%.
Right.
That's very painful. But a lot of the money that went into that is actually from banks and insurance companies, because they're striving for stable return. Because their clients are also looking for stable returns, right? You give me 3%, right? You promise me 2 to 3%, and I go and try to make a spread of, 100, 150 basis points. So, but as you can see, once the 10-year bond yield is below, 1.7, 1.8%, it's totally not sustainable, right? So the government wants insurance money to move out of that bond, right, and try to look for elsewhere. Now, 5-10 years ago, real estate, office are pretty good investments, but now it's still a little bit of a question mark. But if you invest in high dividend yields like banks or utility companies, I think the insurance companies' money are still relatively safe.
Just seeing the CGB yields right there, 2-year, 5-year, 10-year, 30. A little bit of a divergence there. Stephen, thanks so much. Bloomberg Intelligence, APAC lead insurance analyst Stephen Lamb. Plenty more ahead. This is Bloomberg. And welcome back. You're watching The China Show. Well, Argentinian President Javier Milei says his government would leave the Mercosur bloc if necessary to cement a free trade agreement with the United States. Milei spoke exclusively with Bloomberg at Davos about why he sees the South American grouping as an impediment to opening up Argentina's economy.
We are working very hard on the possibility of entering into a free trade agreement. And in fact, when I recently took over as a pro tempore president of Mercosur, I pointed out that Mercosur should move forward on 3 fronts. One related to the fight against terrorism, drug trafficking, and that is also easy to move forward on, bringing down the common external tariff, but also being able to make progress independently. In other words, that each of our countries should have independence to be able to work on trade agreements, because clearly Argentina has decided to become integrated into the rest of the world. It wants to go back to its golden era in history, what was an important world player. And for that, we need to move forward on free trade agreements. We need to open up the economy, and Mercosur can't become an obstacle to that. Therefore, while we work with the US government to move towards a free trade agreement, we also work indoors within Mercosur so that it won't be an obstacle to move towards free trade. So we're working very hard on that.
Would you leave Mercosur to do a free trade agreement with America?
Well, if the extreme condition were that, yes. However, there are mechanisms that can be used even being within Mercosur. So we think that it can be done without necessarily having to leave Mercosur as such. And it's also worth noting this, because often when comments on the negative consequences of leaving Mercosur, reference is made to the automotive industry. But the automotive industry has an agreement outside the framework of Mercosur, so that is a false argument. So we are exploring ways for Argentina to be able to open up to international trade. And why? Because the division of labor brings prosperity. Adam Smith said so. And 250 years later, that holds true. Adam Smith is still right.
There we go, the Argentinian boss speaking with our boss, John Micklethwait, there at Davos. Very quickly, we'll go through some of the markets movers here. Agricultural stocks on the back of this policy push to this rural revitalization plan out of China, and sports also a policy support measure next on your screens, encouraging more outdoor sports coming through. That's playing out across some of these markets, including Alibaba. Anyway, plenty more ahead, including a look at the benchmarks. It's a good day to be in these Chinese markets today. This is The China Show.